Okay, good morning, everybody. Just a quick sound check. Can you please type yes into the chat box if you can hear me? Give a few seconds there just to see if everybody can hear me. Okay, great, everybody. Good morning. Thank you for joining me. I'm Donnie De Lange, and I'm going to take you through Union Pacific's fourth quarter and year-end financial results. Just a quick overview of what I'm going to be talking about today. We're going to look at the nature of business. Then we're going to jump straight to the recommendation. We're going to take a look at the financial report for 2017. Then we're going to take a look a bit more in detail into the different divisions. We're going to look at the company's guidance for 2018. And we'll finish off with the portfolio guidance. So first of all, what does Union Pacific do? Union Pacific Corporation is one of America's leading transportation companies. Its principal operating company is Union Pacific Railroad, which is North America's premier railroad franchise. It covers over 23 states across the western two-thirds of the US by rail, and it provides a critical link in the global supply chain. In the last 10 years, Union Pacific invested approximately $34 billion in its network and operations to support America's transportation infrastructure. The railroad's diversified business mix is classified into its agricultural products, energy, and industrial, as well as premium business groups. It also connects with Canada's rail systems and is the only railroad serving 6 major Mexico gateways. Just some quick facts about the railroad. It covers about 32,000 miles and has about 42,000 employees. It also has 8,500 locomotives and about 10,000 customers. Here's just a quick map of the 23 states that the railway covers. As you can see, covering mainly the western two-thirds of the US. Okay. Now we're going to jump straight to the recommendation. We feel the share offers value at current levels, although given the volatility in quarter-on-quarter earnings, we would only recommend the share to long-term investors. Although the group's forward PE is trading ahead of its long-term average, we believe it is justified given the expected improvement in margins and a tax tailwind. We expect that earnings could continue to be supported by modest volume growth in the medium term, higher prices, as well as efficiency gains. The market is concerned about pricing because increases in the pricing over the quarter 4 came in marginally below the previous quarter. However, management still expects pricing improvements to exceed cost inflation in dollar terms for 2018. This supports management's operating ratio target of 60% by 2019. Pricing should also be supported by truckload constraints after electronic logging devices that set limits on driving hours that were implemented. Although domestically focused, the business is exposed to movement in the US dollar exchange rate, especially given the impact on US export competitiveness. This makes up a material portion of the group's volumes. Other external factors outside the management's control is also commodity prices as well as weather conditions. Other external factors isn't too much of a concern because the business is well diversified across regions that reduces some of these risks. Maintaining fluidity in the network, which is measured by train speeds as well as the terminal dwell times, is crucial to remain competitive against both peers and competing modes of transportation. The group operates in a sector with high barriers to entry, given the extensive capital outlay that is required to build a railway network. Next, we're going to take a look at the financial results for 2017. Firstly, their revenue came up to 21.2 billion, which is 7% up for the year. This includes a 5% increase in the revenue per car and a 2% increase in volumes, with a number of carloads up to 8.6 million. Gross ton miles increased by 5% to 898.7 million, which is obviously a good thing for the business if their gross ton miles increases. The adjusted operating profit rose 8% to 7.9 billion, driving an improvement in the operating ratio to 63%. This was supported by productivity gains despite a 27% increase in fuel cost, with the average diesel price up about 22% over the period. And another thing that did well that supported the productivity gains is the fuel consumption per gross ton mile, which improved by 2%. Their fluidity deteriorated slightly, with the average train speeds down by 5% and the terminal dwell time up by 8%, which was impacted by the implementation of the Positive Train Control, abbreviation PTC. Now, the PTC is a technological system that intends to prevent incidents caused by human error, and the management expects some normalization in the fluidity in the upcoming year. Finally, their adjusted earnings came in 11% higher at $4.6 billion for the year, with their adjusted earnings per share increasing by 16% to 579 US cents due to the share repurchases, which obviously then reduced the number of shares. The total dividends for the year went up from 225.5 US cents in 2016 to 248 US cents in 2017. Next, we're going to take a look at the divisions. These two charts just shows you the contribution of each division to the revenue in the 2 years. We're going to mainly focus on 2017. As you can see, agricultural products contributed quite a lot, 17% to revenue. Automotive a bit less, 9% to revenue. Chemicals, quite a lot, contributed 17% to revenue. Coal contributed 12%. Industrial products contributed the most to revenue, 19%. Intermodal contributed 18%. And other contributed 7% to revenue. Now we're going to look into more detail of each division. The agricultural loads delivered revenue growth of 2% to $3.7 billion. And that was mainly on the back of a 4% increase in revenue per carload. However, volumes were down 2% due to weaker grain and related volumes in the second half of the year. The automotive division revenue was flat at $2 billion. This reflected a 3% increase in revenue per carload, which was mitigated also by a similar decline in volumes. The decline in volumes was mainly due to lower volumes of finished vehicles, which fell by 7%. Revenue from chemical transport grew 4% as the average prices were 5% higher, even though volumes were down 2% on the back of lower petroleum and liquid petroleum gas volumes. In the final quarter, petroleum and liquid petroleum gas volumes recovered with strong growth. Next, we're going to take a look at coal. Their revenue increased by 8% to $2.6 billion. Both the volumes and pricing were higher, with carloads increasing by 6% and revenue per car up by 3%. Okay, so the volume growth was stronger in the first half of the year, benefiting from the reduction of coal stockpiles. Taking a look at the industrial products, it delivered a strong performance with revenue up 22%. This is mainly driven by the volumes that grew by 12%, driven by mineral products and average prices also 9% higher. Then taking a look at intermodal division mainly means 2 or more different modes of transport. The revenue came in 3% higher at $3.8 billion, and this reflects a 3% increase in the average revenue per carload, while volumes remained level. Next, we're taking you to the company guidance. Agricultural volumes are expected to benefit from strong ethanol exports, good beer volumes, and growth in food and refrigerated products. However, the outlook for grain is less optimistic, with an oversupply in global markets and uncertainty on the quality of US crops. In energy, frac sand is expected to continue to contribute strongly in the first half of the year, although going into the second half of the year there is concerns about the viability of local sand. Taking a look at industrial products is expected to be stable for the upcoming year, although plastic volume should benefit from expansionary activities and an increase in resin supply. Light vehicle sales in the US have been forecasted to decline by 2%. However, management expects production shifts to be positive for auto part volumes. Now we're going to take a look at management's full year guidance for 2018. They expect volume growth in low to mid-single digit. They also expect pricing that exceeds cost inflation in dollar terms and saving from productivity gains between 300 million to 350 million. And then lastly, they expect improvement in the operating ratio. They're targeting an operating ratio of 60% by 2019 with a long-term target of 55%. Tax reforms are expected to result in an effective tax rate of around about 25% for the financial year 2018, and it's currently around 37%. Over time, the effective rate should trend down to the statutory rate of 21%. An additional free cash flow of $1 billion is expected from tax cuts in 2018, although the board is still evaluating the potential uses of this additional cash flow. Now we finally get to the portfolio guidance. Following graph just shows you Union Pacific's forward PE compared to the S&P 500 Railway Index. And as you can see, it's pretty much in line with its peers, looking now as if it's a bit below zero, but only slightly below zero, not major discount, so pretty much in line with its peers. We do believe the share offers value at current levels. If you take a look at this triangle, basically a perfect triangle here, offers a lot of value, quality, as well as confidence. It's a very good quality business. It has extensive railway network, and it delivers also attractive margins, also has very strong cash generation, and also high ROE. For those who are not too familiar with financial ratios, ROE stands for return on equity, which is obviously a good thing if it's then high. We would recommend an overweight position with an exposure up to 7%. So before we end off, thank you very much for joining me today. Here's just a disclaimer. Can you please just take a quick read through it? And also, if you wish to place a trade, please contact the trading desk. Also, if you have any questions, please type it into the chat box now, and we'll get back to you via email. I'm just going to leave this on for a few seconds for you to finish reading it. Also, just to give you some time, if you have any questions, you can type it in now. And thank you so much for giving me your time today. I hope you enjoyed it, and please enjoy the rest of your day as well as your week. And thank you very much.